Brad Williams, Frugal Finance, mutual funds, the risk. Because most mutual funds offer a level of built-in diversification, they're typically considered a lower risk investment. However, as with all investments, there are still risks involved, and mutual fund returns aren't guaranteed. Mutual funds also assume some of the risk of the asset that they hold, so be sure to brush up on the risks of those assets as well before you invest. Inflation risk. Inflation rates can impact the overall purchasing power of your investment. Increases in inflation rates and the cost of living may erode your purchasing power and reduce your overall returns. Interest rate risk. In particular, interest rate fluctuations can impact bond prices. Rising interest rates, for example, cause bond prices to decline, which might also lead to a decline in the value of your mutual fund with significant bond investment. Liquidity risk. While investors can trade individual securities throughout the day, mutual funds are typically priced and traded only once daily at the end of the day. Even if you enter a trade early in the day, the price you ultimately receive may be higher or lower depending upon the NAV at the time of actual execution. Market risk. Mutual fund performance is based upon the performance of the underlying investments. Therefore, changing market conditions can impact principal and returns. Depending upon the specific assets held, a mutual fund might face general market risk based on economic or political conditions, natural disasters, and other systemic events with broad impact, such as terrorist-related incidents, which could impact the value of your assets. Comment about risks. You understand investment risk? Brad Williams, Frugal Finance. Thanks for watching. I hope that helped. See you soon.